Alrighty, thank you for coming today, everyone. Glad to see so many people can make it here. It's our second. It's the second time we've done this. It's Econ in English with Johnston. So the whole idea, as you probably know, is to take economic principles and kind of explain them in plain, everyday English. So, what does some of this stuff really mean? I'm not going to talk for too long here. I want to get it off to Lewis. He does a great job with this. So I'm going to hand it off, and I'd like to remind you to like us on Facebook and follow us on Twitter, and I hope you enjoy the event. And speakers in the back. Thanks.
Those of you who've had me for class know that I like to do this. I like to start out with a musical theme for whatever we're doing today. I thought about having something that had to do with things collapsing or crashing or sound effects, but I decided to choose one of my favorite songs, which is called Mean What You Say by Thad Jones, because that's what I want to do today. I want to mean what I say and make sure that you understand some of these phenomena. So I'll turn this music down a little bit while I do a little introduction. One thing that I want to do today is give you some tools for understanding the world. One of the things that's very frustrating, I think, about economics is that we use language that people can't understand. We start throwing around concepts that nobody's heard of, and the whole thing just kind of befogs everybody. So the idea of this series is to take some of the mystery out of what we do. Turn the volume. Even though it's really good. There we go. So, I wanted to just make it fade, but I'm not good at that. Adam, can we work on this for the next one? We'll come up with a song. I got a couple things that Adam's done great stuff.
The singing's coming late.
Yes, you'll see some great stuff that he's helped me with. But let me get the title slide up here and then tell you a little bit about where we're going to go. Turn the screen on, of course. So, what the heck caused the recent financial crisis is the question we're going to look at today. We could spend hours on this, literally, and people have written huge volumes of books that are this thick trying to understand this, so I won't be able to do justice to the topic by any means today. But one of the things I learned a long time ago was some advice. Wow, never underestimate the power of free pizza and extra credit. This is good. I'll take it. One of the things I learned a long time ago, a good piece of advice, some words of wisdom, are from Lorne Michaels, who is the founder of Saturday Night Live. He put a sign up on the first day of Saturday Night Live in the writer's room, and it had these words on it. This is good advice that students probably know inherently, right? It doesn't matter whether you're ready, whether you got everything perfect, it's just time to go. So that's kind of the way today's presentation will be a little bit. Also, I have to apologize, I don't usually like to sit, and I may wander off a little bit, but I'm on my second course of antibiotics for a sinus infection, and the side effects are kind of getting to me. So I may be a little shaky at times, and I apologize in advance for that. But, the show must go on. Richard Alvarez is here. This is good. Here's something Richard sent to me this morning, which was so appropriate. It's dated today from Dilbert. It has, is that Wally and Dilbert? Wally says, "My new hobby is explaining economics using Babel talk. It sounds totally real. For example, did you know that the bubble in commodities is creating an oversupply of interest rates?" And then meanwhile, our chief economist quit. And he says, "Promote that bald guy. He sounds smart." So I don't suggest that you should become Wally after this talk, but I want to cut through some of that. So here's what we're going to do. We're going to first look at what are financial intermediaries, because this is a kind of institution that you need to understand if you're going to understand anything about the previous financial crisis in particular and financial crises in general. And we have to understand how they work. If any of you are specialists, you worked in a bank or an insurance company or something like that, you're going to find my presentation way too elementary, and you're going to think of all kinds of exceptions and things. Great. More the merrier. We can actually have a discussion then that has more information than I have. And then I want to link that, though, to financial crises and bank runs. So, away we go. Let's start with the most recent financial crisis. Let me give you a quick timeline. Those of us who lived through it and remember it probably remember this pretty well, but a lot of you, how many of you, let's see, you're my daughter's age, so let's see, my daughter's a sophomore in college. So let's see, you would have been what, 7th grade? Thinking about this right? 8th grade? Didn't really pay attention to this? Your parents kind of looked worried maybe some days? Their brows are getting furrowed. What's wrong? And you don't really care. But what happened was, between 1999 and 2006, the average price of a home in the United States increased at the fastest rate ever seen on planet Earth for an entire country. Now this is really important to keep in mind. This wasn't your usual increase in prices and then a fall in the price. Prices kept rising and rising and rising for houses at rates that no one had ever seen before except during short spikes of time. By late 2006, early 2007, subprime mortgages, one of the primary vehicles fueling this increase in the household prices, started to melt down. That is, people are starting having trouble unloading these loans if they had them. By March of 2008, a very famous longtime investment bank named Bear Stearns was starting to collapse because of these subprime loans and various financial instruments associated with them. One option would have been for the Federal Reserve, which we talked about at our last session, the Central Bank of the United States, and the regulatory authorities like the U.S. Treasury. They could have said, fine, you made a mistake, you should pay for it, you just need to go belly up. The problem is that institutions like Bear Stearns don't just affect the people who have their money in them. They have spillover effects to the rest of the economy. So the Fed and the Treasury decided, we have to rescue Bear Stearns. We have to come up with a way to keep them from melting down and destroying the entire financial system. If you read some of the memoirs of people at the time, after Bear Stearns was rescued, there's a lot of talk of people exhaling, of saying, well, we got that out of our system. Okay, one bank was going to go. We kept Bear Stearns from collapsing. We're probably pretty safe. You've heard the phrase famous last words. Okay, here they are. Exhale, everything's fine. Things actually start to keep getting worse over the next 6 months. The value of houses continues to sink, and in fact, the rate at which house prices fall starts to accelerate. That is, the house prices start to fall even faster after the Bear Stearns collapse than they already were. Other investment banks, both in the United States and in Europe, that look like Bear Stearns, it's pretty clear they have the same problems that Bear Stearns had. They have securities that are related to these subprime mortgages, and the value of those assets have declined. So by December of 2008, things are getting pretty bad. And the most important dates in here are September 8th, the United States government takes over the two housing finance agencies that are colloquially known as Fannie Mae and Freddie Mac. On September 14th, on a Monday, another investment bank has been teetering on the brink of collapse over the weekend before September 14th. The Federal Reserve and the Treasury decide we don't have the authority to rescue it, so on the 14th, Lehman Brothers goes bankrupt. Does anybody remember that day?
Yes.
That was one of the scariest days I've ever lived through. Because all of a sudden, everyone on Wall Street and in every financial market and in every financial institution was asking, who's next? If Lehman Brothers can go, anybody can go. So the question was, where do we go from here? And pretty quickly, what Ben Bernanke, the chair of the Federal Reserve, Hank Paulson, Secretary of the Treasury, and Timothy Geithner, the president of the New York Federal Reserve, decided was, you know what, I think we were wrong about this whole legal authority thing. I think we need to just rescue whoever needs rescuing, and we'll let the lawyers sort it out later. So within 48 hours, in fact about 36 hours after Lehman Brothers declares bankruptcy, the US government actually turns around and rescues a very large financial conglomerate, primarily an insurance company called AIG. And by September 18th, the Paulson Plan, which comes to be known as the TARP, or the Troubled Assets Relief Program, is announced that says basically we're going to bail out anybody who needs bailing out if they're a bank. So that is kind of the basics of the panic that goes on. After September 18th, things start to settle down. Not good in any global way, but at least the panic part of it is over. After September 18th, that now it's the consequences. It's the terrible recession that was triggered, and all of the cleanup we've still got to do today in terms of dealing with new regulations and things like that. But I think one thing that gets missed is we often go from this to the recession, and we don't step back and ask, well, wait a minute, how did this whole problem erupt? Right? I just told you a story about housing finance and subprime mortgages and all this kind of stuff, but wait a minute, why would that cause a recession, and why would that even cause the financial system to collapse in the first place? Well, let's step back and actually look at that today. So, take advantage of the chair here for a moment. I think the first thing to understand is the idea of what a financial intermediary is. So, if you think about a typical economy like the United States, there are people who want to take resources that they want to put aside for the future, and they want to put them someplace so that they can get at them in the future. Let's call them savers. So, households in the United States, businesses in the United States, foreign businesses, foreign households, governments both here and abroad. They have money left over after they do their current spending, and they need a safe place to put it. There are also borrowers. Here, here. These are people who need money. Homeowners, they need money to buy houses, to buy cars. Businesses need business loans, both to run on a day-to-day basis and perhaps to finance expansion. Same is true of foreign households and foreign businesses. And of course, governments, sometimes it seems, have an insatiable appetite to borrow money, depending on your perspective. Well, in a simple economy or one that was super hyper local, where everybody knew everyone else and you could ask somebody for a loan, or maybe go to somebody who you know needs a loan and say, here, I can tide you over or something. In a modern economy, you can't do that. You need financial intermediaries, that is, people who are literally in between. They're intermediate. And they can match up people who want to save their money and people who want to borrow money. And so what's grown up in the United States is a wide array of institutions that do this job, that match up people who want to buy houses with people who can finance houses, people who want to buy cars with people who can finance cars, people who want to give business loans and know how to do it, and people who just want to start businesses or expand businesses who need the resources. And so there's a wide variety of intermediaries in here. Also included in here are insurance companies. Right? There are people who have enough money that they can put some aside in case they have a medical emergency. And so people will set up an insurance company and promise to pay these people back if some particular catastrophe or some other problem arises. They then take that money, if you're an insurance company, and they lend it. They don't just sit on it. So these financial intermediaries are at the center of a very important part of the economy, matching up people who need resources, borrowers, with people who have resources, savers. So let's take a look at a typical financial intermediary. I'll simply call it a bank. If we're going to be really careful, we want to call this some particular kind of bank, a commercial bank, or a mortgage bank, or a savings bank, or pick whatever name you want. Now you've got cards that a lot of you got coming in, or were handed around or something. This is a slightly different version of what's on the one side of one of the cards. Does anybody recognize what this diagram is? The stuff here on the left versus the stuff here on the right? If you're in Dave Zeller's class, I bet you know what it is. What does this look like? If you're in Dave's class, you should know what this is. I heard it. It's a balance sheet. So this column on the left, yeah, I'm putting you on the spot. You thought you could just be fast. And, there's no free lunch. You ate pizza. You have to participate. So on the left side, traditionally, we put assets. That is, things that a company, or in this case a bank, own. So for example, banks hold cash. They hold money, both in the vault and the drawers and things like that. But it might surprise you, another asset for a bank is the loans, or excuse me, the assets are the loans that they make. Car loans, mortgages, business loans. Those are actually assets to a bank. Now notice they're not the same as cash, and we're going to talk about this in a second, but they sit on this side of the balance sheet. Depending on the regulatory environment, which we'll talk about a little bit, you can have other things here on the asset side. For example, some of you I know are in my American Economic History class. Back in the 19th century, one of the ways that the Civil War was financed was that in order to set up a bank, you were required to buy U.S. government bonds in order to finance the Civil War. It was a way of force-feeding bonds into the general public. Okay? So you have various kinds of assets like that there. And now on the other side are liabilities. And of course for a bank, the most important liability of all are the bank's customers' deposits. I bring my money to you, I give it to you, you're the banker, and you hold on to it. And I should be able to come back and get it when I want. But there's other things besides deposits on the liability side. For example, the people who started the bank have something called equity in the bank. They've put money in to start it, or if this is set up as a corporation, there are shareholders. Again, I'll try to do both sides. There are shareholders who have shares, who have ownership of the bank. This is a liability. We owe them, if we're the bank, we owe that money to the shareholders or to the partners who started it, or whoever the owners are. And then, again, depending on the regulatory environment, there are other kinds of debts that they might take on, and we'll come back to that in a few minutes. Okay, so a lot of you might be familiar with the most simple way of thinking about a bank. Just let me use a little pen here. If you think about banking before the 1970s, the 1980s, most banks looked like this. They didn't really have anything of this stuff. And for all practical purposes, they didn't have any of this stuff either. Banks held cash, or more generally reserves, that is things that they could give to their depositors. The depositors came in and asked for their money. They made loans, and regulations were very careful. They specified the kinds of loans. Certain kinds of loans could be made by certain kinds of institutions, other kinds of loans only by other institutions, and they were separated. And then you had the deposits, of course, and then the equity of the people who owned it. Okay. Well, believe it or not, and you may or may not believe it, you can still have problems in a situation like this. One of the biggest problems is the amount of cash that you have on hand might not be anywhere near what the depositors have on account in your bank. And if all the depositors come to get their money all at once, you're going to be in trouble. This is part of something, and here's where I'm going to try and break down some jargon, that's a really important function of banks that's really useful in a modern economy. It's called maturity transformation. A bank takes things that are really short-term, like deposits. I can go in and get my money whenever I want. That's the ultimate short-term situation. And then they invest that money in long-term stuff, like a house, or a car loan, or a long-term business loan. So they're transforming a short-term thing like a deposit into a long-term thing like a mortgage. But there's always the potential for what is dryly called maturity mismatch. Everybody wants their money and you can't get it. There's a mismatch. Okay. So if we take a look at this in terms of a balance sheet, this is the problem that's called liquidity. So the idea, to go with the metaphor here, is loans would have to be liquidated in order to pay the deposits. And how fast can you do that? Or you may have cash, but do you have enough? So let me give you an example of this. How many of you have seen Mary Poppins? Right? Well, Mary Poppins is one of my favorite movies. And one of the scenes in Mary Poppins is the children go to visit their father who works in the bank. And one of these characters, who I hope you'll be able to see, we'll give this a go, says you should take your tuppence, which they've been planning to take to the cathedral and give to the old lady to buy breadcrumbs and feed the birds. There's an old song, Feed the Birds. He's saying, no, 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 you shouldn't do this. You should put it in the bank and have it earn interest. And so he won't, the banker won't go along with the little boy who wants to keep his tuppence. And so the following ensues. But I had my setup here. There we go. Whoops. Well, see, this is the problem with doing two things at once. Turn that off. See, I'm not as good at this as I hoped, but you'll forgive me. There. Give me my money, he says. Notice what the tellers are doing. Now it's outside, everybody's hearing about this. He's still trying to get the money. They're putting all the money in the ball. So, there's your classic bank run, right there. You've got a liquidity problem. They know in that bank that they do not have enough cash. They can't possibly take all of the loans and other things they've got on the asset side and liquidate them quick enough to give everybody their money. So, a common way of dealing with a bank run up through the 1930s was you simply stop payments. I always like this one because it's so clear. They take the grates and they literally close the windows. So you close the doors on the bank and say, we can't pay. You're going to have to wait till we can get enough money to pay you all. So this was a problem that supposedly was solved, and we talked about this last time, with the Federal Reserve. Remember, the name for the Federal Reserve comes from the idea that you'd have a reserve, a big central bank, or actually in the US 12 of them, that if this started to happen, you could maybe close the doors for a while and they'd bring the cash to you, and you could open up the doors and give everybody as much cash as they possibly needed. And as I told you last time, if you were here, this didn't work out so well because in the middle of the Depression, the Federal Reserve basically didn't do what it was supposed to do. When banks started going under, instead of running to the rescue, they said things like, well, do you have good collateral? What? I have nothing. I don't have any collateral. And they'd make all kinds of conditions and not loan them the money. So liquidity is a problem. But in the 1930s, we tried to deal with that problem by enacting a pretty radical solution. Something that didn't exist even in 2008 in Ireland, for example. Deposit insurance. We set up a system that said, as long as you have under, I can't remember what it was in 1930, but today, $250,000 in an account, your money is guaranteed. It's safe. The US government stands behind it, and you will get every penny of your account back. So that takes care of that problem, at least on the surface. So we got liquidity. That's part of the problem in 2008, but there's a bigger problem. Solvency. That also led to this panic, led to this financial crisis. Solvency refers to the fact that, notice the way I've got this balance sheet drawn up here, or over here, everything matches up nicely, right? I've got the same amount of assets as I've got liabilities. And that's the way a balance sheet works, right? It's where the name comes from. Think about it, it's a balance sheet. Well, what if something happens so that the things over here on the left-hand side, especially the loans and the other assets, start to shrink in value? So for example, the housing market starts to collapse in 2007 and 2008. So a whole bunch of loans and mortgages that you had, they aren't as valuable as you thought they were. And a whole bunch of securities that maybe are based on housing finance, they're not worth as much as before. Well, notice this left-hand side here is going to start to shrink. And if this is a bank and you have deposits in the bank, you're going to start to wonder, am I going to be able to get my money out? Or if you're the person who has lent money to this bank, this is something we're going to talk about soon, if you, say, lent this bank some money on a bond, they might wonder, well, are these people going to default? Are they going to have the money to pay for it? Maybe we ought to do something about it. Maybe we ought to start taking our money out. Or to go even further, by 2008 there were lots of institutions that, at least on the balance sheet, looked like a bank, but they weren't. They didn't actually take deposits, but companies would put short-term money into an institution and expect that they could get out pretty much whenever they wanted. And there would be long-term assets on the asset side of the balance sheet of these institutions. And in 2008, a lot of these institutions who had put short-term money into financial institutions like hedge funds were starting to say, you know, if it quacks like a duck and walks like a duck and smells like a duck, it's probably a duck. This thing looks like a bank, and I think there's going to be a bank run. So this system is sometimes called shadow banking. There are banks, there are institutions that look like banks, but they're in the shadows. They're things that act like banks, but they're not regulated. They don't have deposit insurance, for example. They don't have rules about how much cash and reserves have to be held. They don't have rules about the kinds of loans that can be done. They don't have rules about the kinds of assets that can be held on the asset side of the balance sheet. Yet they're subject now to the same problem that a bank classically is. So even though this next example is from a bank, I think it gets at the idea of the solvency problem. Another video here. And again, you probably will recognize this.
Don't look now, but there's something funny going on over there at the bank, George. I've never really seen one, but that's got all the earmarks of being a run. Just remember that this thing isn't as black as it appears.
Yeah.
I have some news for you, folks. I was just talking to old man Potter, and he's guaranteed cash payments to the bank. The bank's going to reopen next week.
But George, I got my money here. Did he guarantee this place?
Well, no, Charlie, I didn't even ask him. We don't need Potter over here.
I'll take mine now.
No, but you're thinking of this place all wrong, as if I had the money back in a safe. The money's not here. Well, your money's in Joe's house. That's right next to yours. And in the Kennedy house, and Mrs. Maitland's house, and 100 others. Like, you're lending them the money to build, and then they're going to pay it back to you as best they can. Now, what are you going to do, foreclose on them?
I've got $242 in here, and $242 isn't going to break anybody.
Okay, Tom. All right. Here you are. You sign this. You get your money in 60 days.
60 days?
Well, that's what you agreed to when you bought your shares.
Tom, did you get your money?
No.
Well, I did. Old man Potter will pay 50 cents on the dollar for every share you got.
Yes,
Cash.
well, what do you say?
Oh, Tom, you have to stick to your original agreement. Now give us 60 days on this.
Okay, Randall.
Are you going to Collins?
Better to get half than nothing.
Randall, wait. Now listen to me. I beg of you not to do this thing. If Potter gets a hold of this building and alone, there'll never be another decent house built in this town. He's already got charge of the bank, he's got the bus line, he's got the department stores, and now he's after us. Why? Well, it's very simple. Because we're cutting in on his business, that's why. Because he wants to keep you living in his slums and paying the kind of rent he decides. Joe, you had one of those Potter houses, didn't you? Well, have you forgotten? Have you forgotten what he charged you for that broken-down shack? Here, Ed, you remember last year when things weren't going so well and you couldn't make your payments? Well, you didn't lose your house, did you? Do you think Potter would have let you keep it? Can't you understand what's happening here? Don't you see what's happening? Potter isn't selling, Potter's buying. And why? Because we're panicking and he's not, that's why. He's picking up some bargain. Now, we can get through this thing all right. We've got to stick together, though. We've got to have faith in each other.
But my husband hasn't worked in over a year, and I need money. How am I going to live until the bank opens?
How does that produce for faith?
I need cash.
I can't keep margins on faith. I gotta
How much do you need?
Hey!
They were going on honeymoon, and
I
that's their
got
honeymoon.
$2,000. There's $2,000. This will plan us over to the bank reopens. All right, Tom, how much do you need?
$242.
No, Tom, just enough to tide you over to the bank.
I'll take $242.
There you are.
That'll close my account.
Your account's still here. That's a loan. Okay. All right, Ed.
I got $300 here,
All
Joe.
right, now, Ed, what'll it take to pull the bank open? What do you need?
Well, I suppose $20.
Now you're thanks, Ed. That's fine. All right, now, Miss Thompson, how much do you want?
But it's your own money.
Never mind about that. How much do you want?
I can get along with 20 all right. And I'll sign the
You
papers.
don't have to sign anything. I know you pay when you can. That's okay. All right, Miss Davis.
Could I have 1750?
Seven.
We're gonna make it, George.
Six.
It'll never close us up today.
5, 4, 3, 2, 1. Bingo! We made it! Come on, now, you think we made it? Look, we're still in business. We've still got $2 left.
Every econ book that I know of that talks about financial markets references that scene because it's one of the great, I think, descriptions of how a bank run happens. And it illustrates these two qualities, I think, really, really well. They've got a liquidity problem at the building and loan. Right? They've got all of these mortgages, and I'll be over here too. But, your money's in Tom's house, and your money's over in his house. So what he could do is he could foreclose on all of them and somehow force them to pay their money to the bank and then turn that into cash and then pay out the depositors. And actually, if we're going to be careful, they actually have equity. They have shares in the building and loan. They don't have deposits. But either way, they've somehow got to liquidate this. And then the contagion is what I call it, and what other economists call it. Sorry, Mike, I forgot to put that as a word on here. Contagion is the spread of fear, the spread of something terrible happening. Because everybody's worried, well, the bank was insolvent. It couldn't pay its bills. What about you? Are you solvent? Do you have enough assets, even if you could liquidate them at the Bailey Building and Loan, to actually pay off my deposits or pay for my shares? They're all worried that that won't be there, and so the panic starts to spread. Well, that's what happened in 2008, too, but instead of it physically happening in the streets of New York and Boston and St. Cloud and you name it, it happened in computer terminals and online and in financial institutions like hedge funds and multi-purpose investment vehicles. And I could come up with all kinds of acronyms and names, but basically institutions that look like this. They look like a bank. They're shadow banks because they don't take deposits, as I said, but they've got the same problem. They've got a liquidity problem and they've got a solvency problem. And starting in late 2007 and then blowing up by September of 2008, both of those things have come home to roost. So remember, we've got these financial institutions, these financial intermediaries in the middle. A really good question that you might ask is, all right, well, so what if the Bailey Building and Loan goes under? So what if a hedge fund goes under? So what if Citibank goes under? They're going to lose their money and that'll be a problem. Well, notice this is the same diagram I had a few minutes ago, but I've got a different name up at the top. It's called financial disintermediation. And a famous guy actually coined this term, who I've mentioned already. His name was Ben Bernanke. Back in the late 70s and early 80s, he was studying the banking panics of the Great Depression. And the standard story at the time was the problem with the Great Depression was that these commercial banks didn't get the money they needed from the Federal Reserve, and so that drove the economy down. Bernanke said, wait a second, you're missing a bigger problem here. The problem wasn't so much that the Fed didn't bring money in time. The problem was that this sector of the economy was literally going away. You literally had, as he called it, disintermediation. You had borrowers who wanted to borrow. You had businesses that had attractive projects to invest in, but they couldn't get the money because the financial institutions that they would usually go to were gone. There were people who actually were doing all right, who would have liked to have loaned money to these people. But the intermediation was gone. And so the problem in 2008 was, at least the way Ben Bernanke saw it, and I think he was right, was the bigger problem of all of these financial panics isn't that Citibank is going to go down on its own, or that AIG is going to go down, or that Lehman Brothers is going to go down. It's that the whole system, that contagion is going to spread, and you'll have severe financial disintermediation. GM won't be able to get short-term credit. Right? The US government may not be able to get the short-term credit that it needs. What's that going to do, not only in the US economy, but in the entire world? So that's why you have to hold your nose, at least that's the way I think of it, and you have to bail these people out. It stinks. Some of these people did things beyond just having liquidity problems and solvency problems. They stole money. And even worse, in some cases, they manipulated something called leverage. Meaning, a lot of these financial institutions had hardly anything in terms of short-term assets, or short-term liabilities that look like deposits. They had hardly anything in the form of equity. They consisted almost entirely of institutions that went out, borrowed money at one interest rate, and lent it out and bought other assets at a higher one. And that's it. They weren't even really doing financial intermediary stuff. All they were doing was using the market as a big casino. They were using it to take risks and to make money. And the word, again, I forgot to add it onto the list here, is they were engaging in arbitrage. Trying to take advantage of a low interest rate here and a high interest rate here and make money on the difference. And the way they did it was using this thing called leverage. That is, borrow the money and then buy assets with the borrowed money. So take $1 of your own money, $9 of borrowed money, and buy something that costs $10. That's leverage. And the worst problem of all, when you actually are talking about banks themselves, but other financial institutions as well, is a phenomenon called moral hazard. Remember I mentioned we tried to deal with the problem of the deposits by having deposit insurance. Well, suppose that you're a bank, or you're an institution that owns a bank and has other financial obligations, other financial institutions. You know that these deposits are insured. The federal government will pay these off. Why not take a little more risk on this side of the balance sheet? If you mess up, well, bummer. You know, it's embarrassing. It might be criminal even, but the depositors will be okay. We don't have to worry about that. Well, that's what the idea of moral hazard is creating incentives for taking on too much risk, like deposit insurance. It encourages a bank to take on more risk than they otherwise would because they know that they're going to get bailed out in the end. And the larger version of moral hazard is to go back to what I showed you a moment ago, suppose everyone knows that Ben Bernanke and people like that are afraid of financial disintermediation. Well, now you've got moral hazard on the level of the entire financial system, because anybody in the financial systems who's taking excessive risks might think, I'll get bailed out. They'll take care of it. They wouldn't dare let me go under. I'm so big, or to use the phrase that's become popular, I'm too big to fail. They'll bail me out. And yeah, maybe I'll have to pay a fine. I probably won't go to jail. May lose my business or something, but man, think of the riches I could get. I'm being cynical on purpose. I'm trying to exaggerate the idea, but you start to get this creeping into the system. So that's where I want to stop talking, because I've been talking way too much. We need to have more of a discussion. So where can I go back and translate some of this, or help you understand what's been going on over the last few years?
What did GlassSteagall do?
So make sure everybody heard you.
GlassSteagall.
And do we want to use the mics or not mic?
What do you think he's there?
Okay, I think it's good. So I'll repeat the question. So the question is, what about GlassSteagall? So let me make sure everybody knows what that is. GlassSteagall is a set of regulations, part of a set of regulations that were passed in the wake of the Great Depression, which did what I described earlier of restricting what banks could do and what different financial intermediaries could do in terms of their assets and their loans. So you've got the card, but it's nice to have the diagram up there. So for example, GlassSteagall created a category of institution called commercial banks. And if you were a commercial banker, you were only allowed to make certain types of loans, and you were not allowed to do things like write mortgages. Those are too risky. There were separate institutions that were only allowed to write mortgages. They were called savings and loans or building and loans, and depending on the regulatory environment, had different names. There were savings banks, where the depositors were supposed to be people of, modest means, and then whatever you had over here on the asset side was restricted to very safe things so that these people could get their money back quickly and they could be whole even without deposit insurance. Well, GlassSteagall started to be chipped away at starting in the 1980s, and in 1999 it was fully repealed, so that those restrictions for all practical purposes were gone by the late 80s, early 90s, and in an actual legal sense they were gone after 1999. So that you could have a lot more risk on the asset side than before. So is your implicit question asking whether I think we should go back to that? Okay, because I don't want to answer that question. Somebody might make me
Do you think we should go back to that?
No, I don't. I might as well just put all my cards on the table now. It's easy. I think the solution is this box right here. We have to have financial institutions stop playing so much with borrowed money and have more skin in the game, is the phrase that people use. There needs to be more equity, because then if these assets start to lose their value, this is where it comes out. It comes out of the hide of the stockholders. It comes out of the hide of the partners. It comes out of the hide of the people who would be earning profits if there are profits to be made. So I would argue that we need to bump up the equity a lot, and that would deal with that problem, because then you'd ask, is this a good risk worth taking? Well, if it goes bad, I'm going to lose a lot of my own money, not just somebody else's.
How would the government go about raising that equity or bumping up that equity?
You'd basically have to pass financial regulations that said if you're chartered by the federal government, you have to meet a certain level of equity, and this is where the resistance comes in. You'd also have to regulate institutions that either now are lightly regulated or not regulated at all, and say, look, if you're involved in maturity transformation, like I talked about, of any kind, if it looks like it to us, you need to have 20% equity, as opposed to 2 or 5, which is what you saw a lot in some of these institutions. It's intrusive, there's no question about it. But I think it's less intrusive than GlassSteagall. Right? It would allow them to decide, okay, once you have this minimum level of equity, if you really want to take a risk on mortgage-backed securities, all right, go ahead, it's your money, rather than telling you you can't invest in it. So I think it's a regulatory environment, but it's a less restrictive one. I'm sorry, I didn't mean to.
Okay. Then really a big thing that happened was nobody in our Congress had courage to call the GlassSteagall law, and, you know, people should have gone to jail a long time. But, you know, I also think that we don't need the Federal Reserve either. It has no real function except to keep the world bankers quite wealthy.
I got to disagree with you on that. I think the Federal Reserve is really important.
Why?
Because they regulated, well, to be really blunt, I think the Federal Reserve kept us from having a complete financial meltdown.
But who are the Federal Reserve?
Pardon me?
Who are they?
The Board of Governors.
The what?
The Board of Governors, Ben
Board of
Bernanke.
Governors from who?
You should have been here for the first
Four of
class.
them are economists and one is a lawyer. Four of them are economists and one's a lawyer.
But they
And they're
represent
appointed
the
by-
American people? Is this American?
Yeah, they're appointed by the president,
Is this,
confirmed by Congress. It's just like the Supreme Court.
you ever heard of Andrew Jackson?
Oh, yes. Those of you who are in my American Economic History class, we talked about this. Yeah. So this is a tension that runs, you and I are exhibiting the tension that has run through American financial policy for over 200 years. Should we have any kind of centralized control of the money supply and a financial regulation?
But we have that
Or
already.
not.
Let me tell you how. The House of Representatives is the only one that can coin money in this country.
They've given the power to the Fed.
Have
That's what the
they?
Federal Reserve Act does. And if you've read Ron Paul's book, for example, he actually admits that in there, but doesn't like to talk about it. When he talks about ending the Fed, for example, the Federal Reserve Act takes that part, the power to coin money and regulate the value thereof that's in the Constitution, that is expressly given to the Federal Reserve, and it's strengthened in the 1935 amendments. Now, my contention would be, I don't want 435 central bankers.
But we don't need them. We have.
But they would. If we got
have
rid
a
of the
central-
Fed, we'd have the
we have
House
the
doing it.
Treasury. We don't need the Federal Reserve. What for?
I don't know if you want to have this discussion now or not.
Why not? These
I mean, we
young
could.
people need to talk about
I think,
this.
let me answer your question directly. I think we need it for two reasons. Number one, I think we need it to regulate the money supply, because the money supply in our economy is what's called fiat money. It's not backed by anything. So there has to be some way of regulating the amount that's around.
Let's go back on the gold standard then.
Never.
Oh, yeah.
It would be a terrible idea.
Why?
Because in a modern economy, actually in the late 19th century, oh, guys in my American Economic History class, you just lived through a whole day of this, I'm sorry. But I take your question really seriously, so I want to answer it. In the late 19th century, what we experienced was an economy that was on the gold standard, but since the gold supply didn't grow very much, prices fell and fell and fell and fell and fell. We had massive deflation. We had the populists, the farmers saying this is crazy, we can't sell our crops, we can't get decent prices. We had small business people in sounds like St. Cloud saying this deflation is killing us.
But I don't think
and
that
then
was gold
bank
standard.
panics
It's
every
government
20 years.
control of industry, government control of agriculture. I farmed for 24 years.
Yeah.
I know what it was like. I was in the National Farmers Organization.
Good.
We had to move our
The 80s were
products
horrible.
around
The 80s were horrible.
in order to get a price, create a shortage. I mean, this had nothing to do with gold standard. You have to have some kind of standard to give money value. And right now, just to have
There's
the
no-
Federal Reserve printing out paper money out of thin air is not a standard.
But the gold is the same way. What
But
gives
you
gold
can-
its value?
You can agree to make a smaller amount of gold this standard. You can agree to have that, but it still would be a backing.
Doesn't work. Doesn't
And
work.
add silver.
No, didn't work either. That was the cry of the late 19th century.
I don't think
I
so.
have a question. What is this whole Dodd-Frank thing that came in response?
How big
I
is
also
it?
will say, if you want to learn more about the Federal Reserve, you can watch on YouTube our first one,
Watch
which was entirely
Monopoly.
about the Fed, actually.
Have you
so,
seen Monopoly?
cool stuff.
Yeah, it's so Dodd-Frank, to put it bluntly, I think was a horrible lost opportunity. We had an opportunity to actually think through and write a series of regulations for a modern financial market, and instead what we got was a multi-thousand page monstrosity that tried to fix problems instead of directly dealing with the balance sheet here. It tried to deal with symptoms of the problem. So like, instead of directly dealing with the problem of not enough equity in a bank, let's regulate the kinds of assets that different banks can hold. And the bankers and other people are going to come up with ways around that. That's easy. Plus, they didn't write the rules. They said, here are the general parameters, now we're going to let the Fed write the rules, and the Treasury, and other organizations within government write the rules. Well, it's going to take forever for those rules to get written. And in the meantime, it's business as usual in the financial markets in a lot of ways.
It was a good law, did you?
Get you back to two paragraphs.
Paragraphs.
I guess 2 paragraphs. So when you're talking about equity,
Oh.
and the model that comes to mind for me, I'm not sure I'm right about this, that where there's that kind of model is a credit union.
Yeah.
So do you think that everything should look like a credit union, or we should have more credit unions, or is the credit union model something we would advocate?
The credit union model is a good model, actually, because, I'm sorry. Yeah, I think it actually is a good model because it puts puts a lot more equity up front in the institutions. I don't say everything ought to look like that. Pardon me?
What's the barrier?
The barrier, well, the barrier is that there's an old saying that banking used to be a 363 business. You borrow money and give your depositors 3%, you loan it out at 6%, and you get onto the golf course at 3 p.m. So 363 banking. That kind of organization is really boring. I don't mean that as a pejorative, but it's if you're somebody who wants to come up with new ways of doing finance, who wants to come up with exotic ways of funneling money from area A to area B, having something like a credit union doesn't let you do that. And so I actually am very favorably inclined towards that model, but I don't see it happen. I just don't see it.
It's called for honesty.
Pardon me?
And I'm having trouble thinking that Ron Paul would say anything positive about the Federal Reserve because he's still trying to get us to look at it and say, hey, where's everything going here that the Federal Reserve is doing? And that's right there. It's in our Congress right now. They want to do that. They're pushing to do that.
Audit the Fed.
So if he thought, it didn't need to happen, I don't think they'd be trying to do that. So I'm having a little trouble with
He's
you
against
saying
the Fed.
that.
He hates the Fed, and he wants to get rid of it.
We're on agreement with that. But don't tell him that he's okay with some part of it.
He's okay with the no, he's not okay.
No.
He acknowledges that it is perfectly legal that the Federal Reserve coins money. Because it was delegated to them.
Because
But
for him saying it's legal, legal is for our House of
benefits of
Representatives.
having greater risk in the marketplace.
Right.
So we just talked about the benefits of having a more conservative, cautious balance sheet approach. But let's talk about the benefits of that. You mentioned the pejorative term casino economy,
Right.
but what are the benefits of loose or riskier firms and banking regimes and so forth?
I'm hesitating only because there's the theory and there's the evidence. The theory is that more loosely regulated financial institutions would come up with things on the asset side of the balance sheet that would allow innovative financing, we could call it. Ways to finance new entrepreneurs, ways of financing new ways of farming or something like that. That's the theory. But the evidence, I don't think, is there. So, for example, if you look at the growth rate of sectors of the U.S. economy and the overall economy, growth was faster when we had GlassSteagall type regulation than what we've had since there was deregulation. Now, of course, that's not very good evidence because the other thing could be maybe things would have even been worse without deregulation. I don't think so. I don't think so. That's the case, but I'm just not convinced yet it's possible. But that's the idea, is that bankers will come up with more innovative ways to finance new technologies, new businesses, and promote economic growth.
My question kind of relates to, the incredibly elementary, beyond elementary, where we have, because the crisis was the, burst of the housing market. Mm-hmm. Can you explicitly tie that into how this works with the intermediaries?
Sure. So if you think about the balance sheet, it can directly hurt banks because the value of the mortgages all of a sudden start to shrink. So So if people, for example, can't pay their mortgages, the value of this loan box starts to shrink. So you don't have enough assets to cover everything on the liability side. That's the direct way. The indirect way is here in this box. A lot of banks held securities that were based on those mortgages. And I was avoiding talking about that only because the names start to get so exotic and everything, but there are things, for example, called mortgage-backed securities, where a financial institution would buy up mortgages from a whole bunch of banks, hold on to them, and then issue a new piece of paper that promised to pay a certain interest rate year after year, and the way they were going to get the cash to pay those interest rates was by getting the payments on the mortgages. Well, if all of a sudden the mortgage values start to collapse, the value of that security is going to start to collapse, and that's going to hurt that side of the balance sheet. So that's how the how the housing bubble collapsing basically just starts to collapse that side of the balance sheet. I'm not trying to ignore you, by the way.
No, like somebody else.
I just want to make sure people get their questions
You
answered.
haven't mentioned shovel-ready projects. When all this was happening and the government said we're going to throw money at anything that's shovel-ready, where did that play out? Because I don't recall seeing any new WPA type structures built.
Well, if you go back to, this is actually a really, I like this question a lot, but let me just go back here. This is something that I think, as an economic historian, it frustrated me a lot. In this financial crisis, we emphasized lots of work on trying to fix this financial disintermediation and prevent that. And the idea was, if we fix this, everything will be fine. Markets will function again, borrowers and savers will be able to match up, and the economy will come back. And I think that was wrong to begin with as a premise. When an economy gets a shock of the size that it did like this, it's the equivalent, I think, of a person having a heart attack. You can't just go back to normal. Oh, I had it. Okay, I'm back up on my feet now, I'm fine. You need things to help recover. And so what your question is about is, should the government, for example, have done some kind of stimulus policy that involved building things, going out building roads and bridges and things like that? I think they should have. They should have done a lot more than they did. But it's the politics. It barely got through what they got through. And we're still arguing about it. I'm sorry. It's like 3. Stacey?
So I've heard that developing economies like Kenya and Ghana experienced a huge slowdown due to the economic crisis. Was it connected to poor policies in those countries and they're afraid that the West is going to get their money out, or I have trouble connecting
It was that contagion that I mentioned again, that spreading, especially in lower income countries. So imagine you're a bank in Ghana or a financial intermediary in a low income country. You've borrowed money, for example, from an American financial institution. They need the cash now because they're having problems. So they say, I'm going to take your loan. You have to pay your loan off now because I need the money. Well, wait a second. This starts to mess with everything now. Wait a minute. I know we're supposed to pay that loan, but this is a long-term loan. I thought I'd have 10 years. No, I need it next week. I need it next month. So that started to pull on the strings of the international economy as well.
Bank around country size.
Yeah, you get a worldwide financial panic.
And unfortunately, it's now 6 o'clock, so that is the end of the event. If you want to stick around after, I think Dr. Johnston might be available to answer a few extra questions. But I'd like to thank you all for coming out today.